Hello, everybody, and welcome to the November update of Quadriga Stable Return. As always, we're gonna go through the presentation, a quick look at the investment process and the portfolio construction, and then going to review of the month update. As we repeat our investment philosophy, as usual, it's not about, for us, the long-term success, not just about capital compounding, so pure market risk, but also capital preservation during volatile times. And we know the problem we are facing today in cash, money market, fixed income, especially long-term fixed income, long-duration fixed income. We have very poor risk reward and negative real yields. And if you go into more risky assets like credit, we see investment grade is very expensive. Spreads are all-time low and close also, so they are kind of government bond replacement with a bit more spread. So we don't see any credit risk there. But what we see essentially is still a very poor risk reward, and in several pockets, very low nominal yields and also negative real yields. In terms of equity, public and private equity, we see risk reward and real returns a bit more attractive. But of course, we see pockets of valuation in equity markets, which are very scary. And we see valuation pretty high in terms of also expected growth, especially on the growth sector and defensive sector. The multiple are considering, let's say, next 2-3 years of very high growth, double digit. So we already seen in the market is very sensitive to earning warnings about this growth company. As soon as they make minor mistakes, they got punished. And we already see this year companies like Zoom down 40%, Peloton down 70%. But we still see other pockets of market where valuation keep being pretty high. So what we introduce in terms of the portfolio construction, we went through the classic asset allocation with what an investor wants to diversify using different asset classes like fixed income, credit, and equities into behavioral allocation. Behavior means how an asset class or a strategy, which is composed by two or three different assets, long and short, behaves during stressful times. And so there are certain strategies, and also during more quiet and less volatile times. So there are certain strategies that they're really defensive strategies. So they have positive returns during market drawdown, equity market drawdowns, and during, let's say, more quiet, less volatile times, they try to preserve capital. So those are what we call anti-bubble type of strategies, so defensive strategies, risk off. And then there are, of course, on the year, and then of course there are the risk on strategy, which are essentially their equity type, beta type of strategy. Risk on strategies can be carry strategy done with effects, or high yield, or equities, cyclical equities, for example, also growth equity. Those are beta type of strategies, and the risk of strategies, as we already described, they look like this. So they are more sensitive to defensive factors. And then we have what we call the alpha strategies, which essentially they don't have any correlation, sensitivity either to defensive factors or risk on factor. We put all together and we try to build a portfolio essentially that has a bit of everything, but without any any major correlation with one of the factors. And the result, this is just a pro forma, since 2006, is our backtesting since 2026. The result we want to achieve is essentially a smooth profile in terms of capital growth and preservation of capital during volatile times. And here the team, as you already know, since last month we changed the investment process. Now the fund is a internal multi-PM of Quadriga portfolio managers, and so we added a great team of 5 people that they are managing now the bulk of the portfolio, and especially more the alpha and risk on type of strategies. And as you may see, there are people like Rodrigo Hernando working many years here at Quadriga. He's also the CEO of Oro. Then Alfonso Torres, also expert in fixed income rates, and so forth. And then we are a very committed team, senior people, and where we all contributed to Stable Return, which is our flagship fund. It's Quadriga flagship fund. And here you can see the biography. As always, we're going to send this presentation with a replay of the call. So the key objective of the fund is, first of all, is capital preservation. Second is to achieve stable income, and then is also inflation hedge. We are pretty aware that inflation, although this year has been higher than in the last 10 years with 5% inflation in US and in certain countries in Europe, that although the inflation may not be very high next year, being long credit instruments like investment grade essentially is like being short inflation, because also with inflation 2%, yields so low, spreads so low, essentially inflation is eating, is consuming all the nominal returns, poor nominal returns, looking forward in investment grades type of instrument that we want to deliver. So we want to give our clients a different product that can be also an edge to inflation. So same profile of investment grade in terms of risk, in terms of volatility, but with a better profile regarding inflation risk. And 3 building blocks. One is, as we call this, the risk on assets. The red dots can be between 0 and 50%. And then 0 to 50%, we have the defensive risk off type of assets and instrument strategies, the bucket, which you see in the green dots, they behave like put option. And then all the uncorrelated type of strategies, which can be between 50 to 100% of the notional. The strategy can be up to 250% gross exposure. And when we build the portfolio, it's a mix of top-down and bottom-up portfolio construction. We have the strategies coming from our research team, our portfolio managers. Can be pair trades, can be option type of strategies, and then we allocate those strategies according to what our models of risk budgeting are telling us, and we build the portfolio with a volatility ex-ante of 5%. So sometimes the portfolio constraints gives us also 0% in risk on or risk off strategies, and they give more weight into uncorrelated strategies. So if you look into how the fund behaved compared to the peer group globally, we picked the Nordea Stable Return as one of the comparison. Then there is also Nürnberg and Berman uncorrelated strategies we added into the peer group. It's a low volatility defensive strategy, which delivered since we started in January 20, just 3.4%. Nordea Stable Return has been very good fund. So, but if we pick the Nordea Stable Return monthly returns, starting, let's say, from ranking them from the worst to the top return, to top month, and then we put on the same month what happened to Quadriga Stable Return, we see that during the worst period, the worst month of Nordea, Quadriga delivered just minus 1.8 compared to Nordea Stable Return accumulated minus 10, almost 11%. During quiet, let's say, flat returns for Nordea, also Quadriga Stable Return had more or less flat return, although a bit higher. And then during a very good month for Nordea Stable Return, almost 20% accumulated, Quadriga Stable Return was positive, but of course with less beta, less positive. So at the end, what we want to achieve is the same result at Nordea Stable Return. What we try to deliver essentially is on a different type of path. We want to be more defensive, preserve capital, and by the end, try to deliver this 3 to 5% return in the next 3 to 5 years. If you look at the month update, this is the November update. The year to date now is minus 1.2 compared to the European Hill investment grade, sorry, minus 1.7, and the month was positive with 50 basis points. And since inception, we are now 8%, which is still a bit down compared to our target of being inflation, European inflation plus 5%. But if you look more at the year to date, it's been quite also, let's say, volatile month. But this last month has been pretty stable in terms of return, thanks to the changing we made to the strategy. We are managing the portfolio directly into direct instruments, so we're not using any more fund of funds. So this allowed us to be more flexible, dynamic, and quick in changing between risk off and risk on. And so during the month, it's been a good month for our defensive strategies. We had a pair trade, which was consumer staple versus market. It was more in Europe. And then this strategy performed pretty well, especially during the Friday end of November, when the European market was down 5%. We preserved capital, going up 10 basis points. So this month has been very good for more the risk off strategy, and we bought a few call option on the way down on the European markets. So hopefully next month, this month December, they're already working and already added 40 basis to the P&L month to date in December, the first 7 days of December. So, and this is just to show you how flexible we are in moving between risk off and risk on, and also uncorrelated type of strategies. So we still keep the relative value defensive strategy, 11% notional, and then we added 9% notional in optionality on the Euro stocks. We are still in the wait and see moment. We are ramping up the portfolio, so adding few position week by week. We are not in a hurry, and also playing small is delivering anyway decent returns. So 50 basis last month, and we're already 40 basis up this month in December. And just a quick macro view, as always. What I look into the macro, there's been some noise, or let's say volatility around the Omicron variant in November, which the market already is considering as non-dangerous variant strain. According also to Pfizer and Moderna, today they just said that adding a third dose would neutralize this new variant. So let's say positive news on the side. I think that we always should look into what the Fed's going to do next year. I think it's going to be the one of the main driver of risky assets next year. And one of the things we should monitor, as the Fed is to monitor too, is the inflation expectation. You have different indicators. We look into the five-year inflation swaps, and the white line is touch, let's say, almost 3%, and now it's at 2.6%. Is still, let's say, under control. Let's say it's one of the highest points in the last 15 years, but still it's under control. And we see next year how this inflation expectation and also realized inflation is going to play. This is going to be it's a variable we should monitor. And on the other side, what has been news during the month of November, which the market considered a bit, but it was more the Omicron variant taking, like say, the driving seat during those days, was that the Powell speech at the Congress in US essentially supported more hawkish Fed. So in the market, and so this is the white line, the blue line on the chart is the Fed fund expected Fed fund yield for June, the white line, and for June 2022 and December 22, the blue line. And we see that in the last 2 months, 3 months, 2 months and a half, and since September, we moved from just one hike in December 22 to almost 3 full hikes, expected 3 full hikes for 2022. And we moved for 0 hikes for the first half of 22 to at least 1 full hike. So the market has moved considerably to more hawkish Fed. So it's something that we need to have a look at this, because we all remember what happened with Powell and the Fed in 2018, especially the last quarter of 2018. What happened to markets, and then what happened to the Fed funds, and Powell moved also with the economy. So it's something we should always monitor, inflation expectation and market expectation of Fed fund, of, let's say, the Fed next move. And in terms of the curve, this big move has been bear steepening of the curve. Bear flattening. So the short term, the front end of the curve in the US has moved higher than the back end, and that made the curve flatten quite strongly this month. Sometimes this type of movements can be also a bit not, let's say, not positive for a cyclical type of stocks, let's say. And then there is this chart regarding a bit the market and the yield. So the orange line is a classic Tobin Q, which I've been posting for the past few months. This is a very slow indicator. It's a quarterly indicator. So we still use the old data up to September of this year. But we see that the Tobin Q is at the maximum level. It touched the same level and went higher it's a all-time high above 2000.com bubble levels. At the same time, another indicator I like to see and like to watch, monitor, is the bond minus equity yield, which is essentially it's medium term between 5 to 10 years bond plus investment corporate spread, so investment grade, the same duration, minus the earning yield and dividend yield of the equity market. Essentially, we are now still at pretty low level, but we saw in the past that with decent level Tobin Q combined with 2% level in this indicator. So when the corporate bond yield is 2% higher than the equity yield, this can trigger, let's say, a risk-off move, where essentially risk-off assets get more attractive than risky assets. So this indicator is something that we monitor and we all should watch. And another thing to watch for next year is China, of course. It's going to be for sure a slowing economy next year, and the Chinese party really knows it. The central bank just lowered 50 basis points the local rate in order to push banks to impulse a bit the credit. And so we saw that essentially what's interesting, we had a few months of decreasing credit impulse in China. Usually this move was lower in the past, been lower in the past, and at a certain point it triggered quite a risk-off movements, especially in European equities. Then of course they follow through into US equities. But if you look in 2011, 2015, and then 2018, these moves of the Chinese credit impulse was always followed by drawdowns and very volatile markets and lower economy expectation in Europe, especially in Europe. And for now, we didn't see this type of move in European equities, but we should monitor also this indicator. We may have a rebound in this indicator, and this can be positive for medium term for European equities and the European economy. But let's not forget that European economy depends a lot on also Chinese imports. So it's something that we need to monitor and we need to be aware of. The same level of the China imports in the past 3 cycles, 2018, 2015, and 2011, let's say, delivered periods of very market stress that always began in Europe and emerging markets, and then of course is spread into US. So it's something that we need to, another factor we should monitor this last few weeks of 2021 and next year. In terms of strategy, we are almost 44 million, 43.8 million, the UM of the strategy, and we have a quite interesting pipeline. Hopefully we can get to 50 million in the next couple of months. And pricing and liquidity is daily. And we are finalizing the registration in Italy and Germany. And in terms of the share classes, we still have the Steeler share class open. It's going to be open up to 100 million, and then we're going to close it. And so, if you're interested in at least start investing in the fund, or have a sense of the fund, how it behaves, and we are very transparent. And also, you can get the access into the A share class, which is 0 and 0, and this is going to be for a limited period of time until we get to 100 million. Otherwise, we still have the B share class, which is 75 basis point flat, and it works for institutional retail clients. With this, I think I covered all the points. As always, thank you for your time today. So November was a good month when markets were down 1%, European markets were down 1%, we had a positive return of 50 basis points. This month, again, is positive 40 basis points. So decent performance in down markets and decent performance also in up markets. And so the new investment process is working quite well, and happy to have a conversation one-to-one with the potential investor, the one we're interested more in this strategy. And with this, I thank you, everybody, and I'll look forward to catch up next month, January 2022. Bye.